gives me great pleasure to bring on board Hugh Young to talk about the market dynamics, the FI view, the relentless selling by foreign institutional investors, and why are they selling? I mean, Abrdn, for the longest time we've interacted with Hugh. Every time I've used the word India, Hugh gets a smile on his face. So is he also part of the brigade which has been selling into India? You, so nice to have you back. Hope all's well with you. I'm really connecting with you after a good 1 year.
Yes, all is well. I'm sitting here in Singapore, luckily in a room on my own, so I don't need to wear a mask, thank goodness.
What is your view of the world, my friend? A lot has changed. A lot has changed indeed.
Yes, well, a lot was changing before the Ukrainian crisis blew up, but of course, that's really thrown things into confusion. So we were seeing tightening coming through, inflation coming through, possibly resulting in stagflation. Now with Ukraine, we've seen commodity prices spike even further, both soft and hard commodities. So it's a far more pressure on inflation, and arguably makes stagflation look pretty inevitable this year. So it's going to be a tough year for markets. In a sense, I would say markets are still very resilient in the face of this. Yes, they're down 10, 15% or so this year, which is never pleasant, but I've been operating long in markets and seen market moves of 30, 40% in very short spaces of time on arguably news not quite as worse as the news we're getting out of Europe. Although it's still a little early to call that one, but it doesn't look good.
So are you making a case, and I don't get this one wrong, are you making a case that look, even though markets have adjusted, there is still a significant amount of downside still left? I'm underlining the word significant here.
Yes, probably. If I would say that if, and this is the $1 million if events pan out really badly, so which is a distinct possibility. I'm not going to guess at the probability of that possibility, but yes, I think markets do have scope to fall further. As you say, further substantial fall of 15% or more is possible. But so saying, I look at the portfolios that we have, and they're sitting on 14 times earnings as an aggregate for some of our Asian portfolios, of which India's a decent chunk. It's about 15%. You look at the companies, the balance sheets are strong. We're assuming some form of earnings hit this year. It's a bit early to predict how much that earnings hit is going to be, but we've been shaving off our earnings estimates just as a matter of prudence, but still looking very reasonable value. But of course, we're talking about a very confusing macro environment and a geopolitical environment that so far we haven't been very good at predicting.
So Hugh, what is the best way out to isolate your portfolio when you know that the storm has not gone and more downside cannot be ruled out? Is it about raising cash or investing differently?
No, I think for us it's very much sticking to our knitting, sticking with the quality end of the market, sticking with the companies we know well. Of course, trying our best to avoid those that are a bit expensive with vulnerable earnings. And there will be some sectors that will be worse affected by what's going on, particularly dependent on raw material costs, for example, input costs. If it's any of the hard commodities that have seen dramatic price increases, or indeed soft commodities. So there's going to be a squeeze on for certain companies. So it's more a matter of stock by stock. Just being prudent. When we run our portfolios, we typically don't run vast amounts of cash because, again, it's a component of our clients' portfolios. So in a sense, it's their choice whether they buy our India fund or our emerging markets fund or whatever. And we do our best to get returns within that universe. But cash decisions, or the really big cash decisions, are within a client's own portfolios, whether they be an institution or a retail investor.
Hugh, why is the FI selling into Indian stocks rather overwhelming? The numbers now run in $16 to $17 billion, and to put in context, just for our viewers, these numbers are greater than what we saw when the world literally melted away in 2008.
Yes, I think a lot of that is crudely risk aversion, emerging market funds, which in the good old days were brick funds. So the R in the brick has disappeared as a market, so it's gone to zero, and I think that's caused a lot of investors to pull away. We haven't actually seen huge redemptions in our emerging market funds, but there were, or indeed in our dedicated Asian funds. But of course, others will have seen that happening. In certain markets, there'll be sort of a withdrawal of margin lending, but generally people flight to safety. So that's why we're seeing it. And I think we're seeing it, it's not particular to India, which is why, India's down, give or take, in line with other markets.
So it's good to hear that you're not getting redemption in the funds which you manage, because you're not a top-down investor, you're a bottom-up investor, which is that you look at individual companies. So can I say that the selling is largely macro and ETF and country domicile funds who are selling not because they want to sell, but they have a compulsion to sell?
Yes, as far as I'm aware. I mean, I haven't got the statistics in front of me, but yes, that's exactly what will be going on. Just people thinking, oh my goodness, we could be having another major pan-European war at an extreme. But of course, that extreme that we would have called a huge extreme 3 weeks ago is not nearly as extreme today as it was then. So it's more of a possibility than it was, and people are simply pulling back, looking to go to safety, whatever that may be, and that differs for many clients. So it might be gold, it might be back into cash, and the like. And professional fund managers such as ourselves are simply reacting to that, and being effectively, as you see happening in India, forced sellers.
Over the course of next couple of days and weeks and months, would you be looking at increasing your India exposure after the recent fall? Why I'm asking you this is because last time when we interacted with your firm, the view which we got was that India was an expensive market, and China at that point in time, somewhere in end of 2021 or third quarter of 2021, China looked attractive.
Yes, for us, it's how does India look relative to the other areas we invest in. With our dedicated India funds, we of course have no options, so we're looking within India itself, but the bulk of our money is investing in India are either regional or part of a global emerging markets fund. So it's very much looking at where India stands relative to other markets in terms of valuations. And India for a while has been an expensive market relative to other markets, particularly with China's fall last year. So the relative outperformance of India was actually very high last year. But of course, that makes China a bit more attractive. Although, again, at a distant realms of possibility. China and Russia are quite close, so could there be issues there from a geopolitical point of view? Yes, of course there could be. We're not anticipating them, but you never know. So China's not without its dangers, but now as a market looks a bit cheaper than India, arguably a bit more attractive. But again, funds like ours, and I think I'm probably speaking for many of my competitors too, will have a large exposure to China already. So I think if anything, you're seeing maybe a bit more interest in places like Southeast Asia, a bit more into the Malaysias, Indonesias, which from a macro point of view stand to benefit a bit more from increasing commodity prices, and have been neglected markets for quite a while because they're very small markets. So all the emphasis has first and foremost been on China within the Asian region, and secondarily India.
You, for the longest time, you've bought into growth stocks at reasonable value, and you bought into private banks, you bought into IT, you bought into consumer companies. Has that orientation changed, given that everybody is now of the view that growth will take a back seat, value will make a comeback, don't focus on cash flow, but focus on enterprise value and the P multiple?
Well, yes, there is arguably a shift, although if you look at our portfolios, we still very much like the banking institutions. So we have large exposure to the twin HDFCs, to the Kotaks of this world, as indeed do we have large holdings in Infosys and TCS and some of the consumer stocks, such as the lever operations. So we still like those. Are we seeing a bit of a shift in markets? Yes. Some of it is to what I would call the lower quality names, which have been picking up in various markets. Some, of course, the pure commodity names, which have been moving quite strongly as well. So there's a bit of that coming in, but we haven't really shifted from our focus on quality growth, because we think that will still come through strongly. It might have a blip this year with various pressures, but long term, and we are long-term investors, we're still sticking to the tried and tested ways of investing. But we do have tough years, of course. Not every year is a brilliant year.
You've been a big fan of HDFC Group of companies, and I remember interacting with you in 2007, top holding HDFC Bank. 2015, top holding 2000 HDFC Bank. 2022, top holding, I would imagine, is still the same. Is there a concern about HDFC Group of companies? Because those group of company stocks, whether it's insurance or bank or limited, it's getting smashed.
Yes, and there was a worry even back in 2007. How long can it go on? How long can premium ratings go on? Will earnings pause? And certainly we saw some very high prices coming through for HDFC. And it's still one of our top holdings. We try and be clever from time to time, taking a bit off, which we've been doing, but still fundamentally, I would argue, very strong underlying businesses. But I'm afraid the share price won't go up every year. It needs in a sense, a bit of a catch up of earnings, and that happens from time to time within the growth areas. Certain stocks, yes, get a bit overvalued. Earnings catch up, share price does nothing for a year or two, and then hopefully we go on to the next stage of share price growth along with earnings. If only it were sort of nice and steady, so a nice 10 to 15% in earnings growth a year combined with a same in the share price. But sadly, markets don't work like that. Although over time, if you look back, that's precisely what they've done. But there have been some very bumpy years in between, and we might well be due for a bumpy year this year.
Your team identified, let's say, the private banks way ahead of the curve. For the better part of for the better part of last decade, you've been holding on to private banks. That trade has worked like a charm for you. So what is that multi-year trade or investment for, for India investment for you? We're excited to know that where are you really excited about the medium to long term earnings prospect, because if earnings are strong, markets and prices will automatically go higher. You and me can only predict earnings, not prices. So let's do that. Where are you confident of reasonable 15 to 20% earnings growth?
Well, I still think we can get that from some of the private banks. I think we can get that from ITs, some of the consumer plays, looking certainly beyond this year. Which is a bit of a question mark until we see how far earnings have been affected by higher input costs. And then, of course, we're seeing some of the new companies coming to market, which are quite exciting, where you can still see very strong earnings growth. So we've dipped our toe into some of the new companies coming to market, have been so far very pleasantly surprised by the share price movements, although arguably the share price movements are a bit ahead of some of the underlying earnings. So things like Apple that we bought on the IPO has done extremely well since. So there's lots bubbling away in India. It's become, I would say, certainly over the last year or so, a far more dynamic market for new world companies, which is good.
Have you looked at Zomato, Policy Bazaar, or for that matter, even Nykaa?
Yes, we have, and we have a small holding in Nykaa, for example. Sometimes bits of leaps of faith in terms of valuations, but again, within dedicated India portfolio. So that's what we're looking. That's what we look at. Those types of companies, I think, make quite an attractive addition. So we've not just in that area, but we've bought Vijaya Diagnostics and some Map My India as well, which are nice complementary holdings to the stalwarts of, as you say, HDFC, Infosys, TCS, and so on.
If Hugh Young has to go on a holiday, a long holiday, and has to lock 3 stocks or maybe 5 stocks in India, and you know that even if you're on a holiday, you're not worried about those businesses, which would be those ideas? I'm giving you a chance to go on a holiday, my friend, a long holiday.
Well, I do take my holidays, I assure you. I'm too old to be working 7 days a week, so I do like my holidays. And it would have to be a very long holiday. So this would be a 3 to 5 year holiday, which I'd rather look forward to. Which ones? I mean, I think I'd just put the balance as our portfolio is today. I mean, that's how we think about our portfolio. So yes, I would never pick 2 or 3 because you can almost guarantee that those will not be the top 2 or 3 looking ahead 3 years. We're always slightly surprised by which stocks do well and which stocks don't do so well. And sometimes their businesses grow far faster than expected. So the fast growth, the really surprisingly fast growth, could be coming from the likes of Apple, MapMy, the smaller companies, but also they're inherently a bit more risky. So as you can tell from us, we're rather sort of conservative, well-researched, balanced investors, trying as best as possible to hedge our bets while still being fully invested in markets.
You own Asian Paints, you own HUL. You mentioned that you like consumer stocks, and it's time to look beyond this year in terms of returns. Why do you like consumer stocks in India? Because A, they are expensive, B, the price is getting competitive, and C, the uniqueness what an HUL or a Nestle had, that is suddenly getting challenged because distribution is now going more online and internet brands are getting created.
Yes, and they've always had challenges for over the 20 years that we've held a Unilever or whatever, Asian Paints and so on. We've held probably for the best part of 30 years. I'd have to look back in my records. So I think that, I mean, you're right. They're not expensive, and there are always concerns over how long and how fast the growth will be. We don't know, and that's again why we're diversifying. So it's gently. So you're seeing new names come into the portfolio, and at the margin, money being taken out of some of the long-term winners. But I'm not sure I'd write any of these off yet, and they're challenges, and it's the challenges that keep companies on their toes, because a company needs to be challenged to reinvent itself all the time. It's happening in every business, happening in our business, and the like. You come under tremendous pressure, and you just have to make your business more and more efficient. But I think it's a legitimate concern to worry about how much a lever, for example, can get out of its business. Certainly in a global sense, it's a company that's been quite challenged. You've still got some inherent dynamics in India. If the economy grows, people should ultimately be buying more lever products. But you're correct in saying there'll be a lot more choice, and distribution's been key to Unilever's success worldwide. And if that becomes more democratized through sort of modern delivery systems, that's a challenge. So lots of challenges. It's not easy, is it?
Say you don't they that investing is simple but not easy. I mean, I just admire the way how how Abrdn Asset Management, you Adrian, you pick up simple businesses, you make it look very easy, but the fact that you managed to ride the volatility in some of these banks, you've not changed your view. I sincerely admire that you identify businesses and then you think in terms of not days or months, but you think in terms of decades. You looking at the starting point right now, let's say if today is the starting point, do you think Indian markets, not in currency terms, but in absolute terms, can they give a double-digit mid-teen returns for next 3 to 5 years, which means that can your portfolio theoretically double in next 3.5 to 5 years?
Yes, I think that's within the bounds of possibility. Yes, is that a base case? No, I would say that's an optimistic case. So you've got a wide range, and I've seen periods of 3 years where markets have fallen, but earnings might have risen. So an awful lot has to do with sentiment and investment flows, even in a what you might call a long period, such as 3 years. So you can have earnings grow at the 10 to 15%, which I think India is quite capable of doing that. So I'm not sure that is an optimistic case. That might be your sort of base case that earnings from India should grow in double digits. Now, will that then be reflected in share prices? That's the issue we never know. And at times we've given up trying to guess what that will be, because that in a short period is more important than the earnings, and that's where you get the volatility. But thankfully, because we do try and look 5-10 years ahead, we hope that volatility of ratings of stocks will be smoothed out by the underlying earnings. But it takes patience, and not everyone has patience, and that's again contributes to the volatility as well, as far as money going in and out of any market.
So India is now the 6th largest market. It's an investable market where more than 20% of the free float in blue chip stocks is owned by foreign investor. I'm an optimistic, but if I say that India is perhaps the best large cap earnings growth story available for foreign investors, will this be a tall claim or will this be a realistic claim? I'll say it again. Is India the best large cap growth story available in the world for foreign investors?
I think I would moderate that by saying one of the best. I'm just trying to think what would be better than India, and nothing springs to mind, but I'm so reluctant.
Say it's best, Hugh. If nothing springs to your mind, it is the best.
Yes, but I couldn't possibly say that. I'll let you say it, and I won't violently disagree with you either.
Hugh, what is the bear case scenario for India? We'll wrap it up post that. What could go wrong? And what do you think will take this laughter and this joy away of this interaction?
Well, of course, what's happening on the global stage has the potential to blow up many markets, including India. Although I would argue that India should be one of the more resilient economies, if you like, if things really do blow up. Save the issue of energy prices, which is a big swing factor for India. And then very much it's what happens domestically. And domestically, it's been steadily going in the right direction. I mean, not always sort of from time to time it can be 2 steps forward, 1 step back, but ultimately going in the right direction. So domestically things look quite healthy. I would say the biggest risks are externally. But of course, we've got to cope with things like interest rate moves, inflation, and worldwide, if money gets sucked out of equity markets and goes back to arguably a more natural home of fixed income markets. Again, that will be driven by interest rates.
I'm tempted to ask you one more last question. I know I'm shamelessly extending my appointment with you, and you got to get back to your desk. It's almost lunchtime in Singapore right now as we speak. You're not selling India. That's a comfort because you are one of the biggest investors in India. But when do you think the trend would reverse in terms of ETF, in terms of the macro selling? When do you think FIs who've been selling into India, they could be tempted to come back into India?
It's very hard to say. Again, that will be a global issue rather than an India-specific issue. If I could say, well, providing India did this, people would come back, and it's not really been because of anything India's done that people have exited. I mean, it's been a global move out of markets. So it's when we get people coming back into markets. Will India be top of the list? Not necessarily. It's not first and foremost on everyone's investment universe. But for dedicated emerging market investors or Asian investors, yes, it's with China up at the top of the list. And then it's the matter of when global confidence comes back in, which as we speak today is hard to see when that's going to happen. But given the changes we've seen over the last few weeks, change can happen very dramatically. But it's hard to see change dramatically improving in such a short space of time. Let's see.
And I hope to see you very soon, whether it's your office at Singapore or our office in Mumbai. I hope to see you very soon in person.
You're very welcome. Yes, it would be nice to catch up in person. At least travel's got a lot easier now, so I think it should be possible.
Yeah, here's to a cup of coffee in person with you very soon. Appreciate your time, my friend. So glad you could join us.
Thank you. Bye.